Hey everyone, and welcome to The Explainer. I am absolutely thrilled you're here today. Look, we all know what interest is on the surface, right? But today, we're skipping the basic textbook definitions. We're going to deconstruct the hidden machinery and honestly the behavioral psychology behind it all. Interest is literally the underlying engine of the entire global economy. It's this invisible force dictating the flow of capital all over the world. So, we're going to bypass the usual agenda today and just jump straight into the fundamental mechanics of how this force actually operates.
Okay, I want you to picture this. Imagine lending exactly $100 to a friend who really needs it for a month. Now, when you hand over that cash, you aren't just handing them paper. You are engaging in a pretty complex financial calculation, even if you don't realize it. You're sacrificing your own liquidity. You are actively giving up the ability to use that $100 for your own needs, your own purchases, or your own investments right now. Plus, you're taking on counterparty risk, which is just a fancy way of saying there is a very real mathematical probability that your friend might not actually pay you back. Fast forward 1 month later, and that same friend returns a newly minted amount to you, $105. Now, that extra $5, it isn't just a polite gesture or a simple thank you. In strict financial terms, it's compensation for your opportunity cost. It is the quantifiable price of all the things you couldn't do with your original money while it was tied up in their pocket. You took on the risk, you forfeited your cash for 30 days, and this extra $5 is the market's way of making you whole.
Okay, let's dive into this. That extra $5, that's interest. We often simplify interest as just the rent paid on money, much like paying a daily fee to rent a bicycle. But there's a really crucial difference here that savvy investors understand. See, when you rent a physical asset like a bike, it depreciates over time. It gets worn out. But when you rent out capital, you are providing the exact fuel needed to create more capital. It's the cost of borrowing money or the direct reward for lending it. It acts as the ultimate utility fee in our modern financial ecosystem.
Chapter 1. Renting Money. To really ground this abstract concept, let's look at a microeconomy between two neighbors, Liam and Sophia. On day 1, Liam wants to buy a $200 bicycle, but he's exactly $50 short. Sophia steps up as the liquidity provider. She happens to have some extra cash in her savings. But when Liam asks for a 1-month loan, Sophia intuitively calculates her personal time value of money. By handing her cash over to Liam, she loses the ability to use it herself, so she requires a tiny $2 premium to offset that loss. 1 month later, Liam hands over $52, settling the agreement.
And this brilliantly illustrates exactly how the entire global banking system operates. What Sophia and Liam just did is the exact same mechanism, fractional reserve banking, that has fueled human economic growth for centuries. Everyday people deposit their money into savings, acting as millions of individual liquidity providers. The bank pays them a modest little yield for holding that capital. Then the bank turns around and lends that massive pool of money to borrowers who need mortgages or business loans, charging them a higher rate. The difference between what the bank pays you and what it charges the borrower, that's called the spread. And that spread is the fundamental revenue engine of modern finance. Every single time you log into your bank account, you are participating in this massive money rental business.
Chapter 2. The Reward of Interest.
Now that we've got the core mechanics down, let's shift to the fun part, the highly optimistic side of all this. What happens when you are the one holding the capital? Think of it like a giant mango tree. You don't have to plant a brand new tree every single season, right? A mature tree just continually produces new fruit year after year. Well, in advanced finance, we call this a yield-generating asset. When your money is deployed intelligently in savings or investments, it slowly and automatically produces more money without you having to lift a finger. It is the absolute beauty of passive capital generation. And the longer you let it mature, the bigger the harvest.
Let's reinforce this with another classic economic model, the farmer. Imagine a farmer lending 10 bags of wheat to a neighbor. He isn't just doing a good deed, he's strategically deploying his excess capital to generate a tangible return. When that neighbor returns 11 bags at harvest time, that extra bag is the yield. Whether you're trading agricultural goods or buying corporate bonds, the fundamental dynamic is identical. You're consciously choosing to trade your present utility for future abundance. You are basically saying no to consuming things today to make sure you are structurally wealthier tomorrow.
And here is where the mathematics of wealth creation truly accelerate. We're moving from a straight line into geometric progression. It's like a tiny snowball rolling down a hill. When you reinvest the yield, when the fruit from your mango tree plants new trees which then bear their own fruit, you trigger compound interest. You aren't just earning interest on your original money anymore. You're actually earning future interest on your previous interest gains. There's a profound reason Albert Einstein supposedly called compound interest the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. With enough time, patience, and consistency, this scales modest little deposits into surprisingly massive wealth. It's literally the single most powerful lever in personal finance.
Chapter 3. The Cost of Interest. Now, looking at all that incredible wealth generation, you might be wondering, is interest always a good thing? The answer is a definitive absolutely not. Let's look at the behavioral psychology of the credit card trap. Our borrower, Liam, buys a shiny new phone on a credit card. Because human brains naturally struggle to weigh future penalties against present desires, smart people fall for the allure of the minimum payment all the time. They get the immediate dopamine hit of the new phone while deferring the true cost. But here, that snowball of compound interest works in reverse. It becomes a merciless wealth destroyer. The high interest penalty is continually added to whatever balance is left. So while the phone itself is rapidly losing value, the total amount Liam owes is growing geometrically. He's no longer making his money work for him. He is trapped, working purely to pay interest.
Sophia hits the nail on the head with this vital observation. Interest doesn't care whether you're rich or poor. It follows the same rules for everyone. I mean, that is a profound insight to internalize. Interest is just a fundamental mathematical law of the economic universe. It is completely devoid of morality, empathy, or context. It doesn't care if you're having a tough month, and it definitely doesn't care if you lost your job. The compounding clock just never stops ticking, and the equations never change. Understanding these completely neutral, unrelenting rules is absolutely crucial for taking control of your financial destiny.
Chapter 4. Building Financial Wealth. Let's fast forward 10 years to see a fascinating divergence in our two characters' financial destinies, based purely on how they allocated their money. Over the decade, Liam finally developed a disciplined habit of saving, while Sophia aggressively scaled up her investments. So, the crucial point is grasping the stark contrast between good interest and bad interest. Remember, it's the exact same mathematical formula applied in both scenarios, but it yields entirely opposite life outcomes. Good interest is deploying capital wisely so the math works endlessly in your favor. Bad interest is borrowing too much and working just to pay the penalty. They both learned that interest isn't just some boring banking term, it's a neutral tool. When harnessed, it builds empires. When ignored, it crushes you.
Now, navigating all of this depends entirely on understanding exactly why different financial products carry vastly different rates, and it all comes down to the concept of the risk premium. Let's break this down real quick. Savings accounts pay relatively low interest because they are highly liquid and virtually risk-free. You're trading a high yield for guaranteed safety. On the flip side, unsecured loans and credit cards charge exorbitant rates to compensate the lender for the massive risk that you might default. And then you have market investments. These offer variable returns because you are stepping out of the safety net. You're demanding a higher risk premium to compensate you for absorbing market volatility and the very real chance your asset could lose value. Mastering wealth creation really means consciously balancing this risk premium across your entire life.
Bringing this entire explainer full circle, we arrive at the absolute core of today's analysis. Borrowing and lending are quite literally two sides of the exact same financial coin. Borrowing is the unavoidable price you pay to pull future capital into the present. Lending, or saving, is the calculated reward you demand for pushing present capital into the future. Every single financial choice we make places us firmly on one side of this dynamic. We're either paying the toll or we're collecting the premium. So I challenge you right now, take a look at your own balance sheet. Analyze your accounts, your debts, your assets. Which side of the equation is carrying the most weight for you?
Remember, time is the great multiplier. Every single day that passes, the geometric curve of compounding is quietly doing its work in the background. It is either exponentially expanding your net worth, or it's slowly eroding it away. The math is already running. The only variable left in the equation is your strategy. Which leaves us with the ultimate question. Will you let interest work against you or for you? Think about that. Optimize your money today, and I will see you in the next explainer.